Okay, welcome everyone to Insurtech Australia's webinar today, focusing on Insurtech Investment Trends and Update in conjunction with Insurtech Gateway Australia and DLA Piper. We really do miss not being able to run these events in person with you and hope you're all doing well at the moment. But it is also great that we can run these events in a virtual forum and still be able to chat to you virtually. As you know, at most of our events, we usually provide you a little bit of an update on what's happening in our business at Insurtech Australia. We're going to keep that very brief today. Obviously, our landscape is changing around us very rapidly, and obviously we are also dealing with that at the minute, but for the most part it's really business as usual at the moment. So for the last month we welcomed 3 new Insurtech members and also welcomed a new platinum corporate partner in Hollard Insurance, which we're very excited about. We've also spent a lot of time reaching out, of course, to our members and partners and finding out the things that they're dealing with in their businesses at the moment and how COVID-19 is affecting them. Of course, we have been working on transforming all of our event series into virtual formats, such as today, but really focusing on those topics that are of the greatest importance at the moment in our ecosystem today. So for those specifically interested in investment and Insurtech investment, which I'm assuming is the majority of you today, considering you've logged on, we do have an event running on the 3rd of June as well, which is going to be featuring RAC's Better Labs. And Better Labs is a $23 million investment fund backed by RAC, and we're really happy to have them chat to us on the 3rd of June. They're going to talk to us about what they're looking for in investments and the way that their fund is structured. So perhaps pop that one in your diary, and I'll mention that at the end of the session today as well, just as a reminder. Another thing that's happening in our world at the moment is we're about to close the surveys which go towards this year's Insurtech Ecosystem Report and Map. So that is done in conjunction with EY, as most of you would know. It's the 3rd year we've released this report, and that report will be released in July of this year. So very much looking forward to that. Okay, so before we actually begin proceedings today, we are going to launch a poll for the audience, and it's actually just telling us a little bit about where you come from, as in what organisations you're representing. So if you wouldn't mind, hopefully you can see the poll there and you're able to log on and vote. And actually our second poll has popped up there as well. So that's some information for you, Lyndon and Simon. The second question is actually looking at whether you are going to be raising capital in the next 3 to 6 months. So I'll just give you another minute or two to pop your results in there. Excellent, thank you. That's all coming through at the moment. Awesome. 10 more seconds and I'm just about to end that there. Great. Okay. So thank you for that. So it looks like from the results there's a pretty good split from different organisation types, whilst we have a few more Insurtechs than incumbents and a bunch from other as well. And there is 35% of you actually looking to raise capital in the next 3 to 6 months, which is actually fantastic. So glad you've joined us here today. Okay. So really there's no doubt that globally the COVID-19 pandemic has had an effect on investment across most industries, Insurtech not being immune to that. For those that are not regular readers of the Willis Towers Watson quarterly Insurtech briefings, like myself, I read it religiously. The Q1 2020 report was released last week, and I thought I'd just pick out a few key global highlights in the statistics there. Looking at the global investment in comparison to Q4 2019, which was actually a record high, there has been a 54% drop, which is probably not unexpected. And in saying that, Insurtech still managed to attract US $912 million during Q1, which is still a substantial amount of cash. Looking at the split between P&C and life and health, 83% went towards P&C. And then looking at the value chain, the two most common areas that attracted funding were policy distribution and tech-enabled claims management. So Adam Baker from Willis, who is one of our partners, is actually on the line today. So if you have specific questions about the report, he's happy to refer to those in the Q&A section as well. So you're welcome to pop questions in specific to that report itself. And my favourite quote, I think, that came out of the report was this one here. If we ever needed a reminder as an industry of the importance of technology, remote functionality, online interaction and digital processes, it is this current environment in which many of us find ourselves. So on that note, we are going to move into the core of today's session. I'll just tell you about how it's going to run. We have two speakers joining us today, and they will present first, and then we'll have 15 minutes at the end of the session for Q&A. So during those sessions, if you have questions, please pop them into the Q&A, and we will get to those at 12:45. Hopefully you've got lots of those questions. Okay, so for our first speaker today, Lyndon Masters is joining us, who's a partner in the Australian corporate practice of DLA Piper. He's also a member of our Insurtech Australia Advisory Committee and a co-founder and co-chair of DLA Piper's Disruption Innovation Group. He's very active in advising technology companies of all sizes when it comes to fundraising, M&A, technology partnerships, and corporate VC in the Asia Pacific region. So it's a real pleasure to me to now hand over to Lyndon. Thanks, Lyndon.
Thanks, Rita. Thanks very much. I couldn't have given that intro better myself. It's like I sent it to you. So thanks very much. Thanks, everyone. Thanks for having me. It's great to be here. Obviously, we're in what I consider to be the most amount of change that I've ever seen in a market in my career. I think even more so than the global financial crisis of 10, 12 years ago now as well. So I think this is a really timely seminar to have, because I think, with the indication on the poll that, a lot of you are looking at actually fundraising in the next 3 to 6 months. I think what we're seeing in terms of the market at the moment and the trends in the market are going to be really relevant for you about thinking about your strategy towards fundraising. Who are the key players that you probably need to be talking to, and who are people that probably are going to be a bit slower in this market to either engage at all or actually kind of write checks, particularly until we see a little bit more certainty in the market. So as Rita said, I'm partner in the corporate group of DLA Piper. For those of you who don't know, DLA Piper is a global law firm. It's one of the largest firms globally. In terms of a sector focus, we've probably got one of the most preeminent global tech practices, born out of about 30 years in Silicon Valley, but then also expanding that out globally as well. Our practice here in Australia is about 50 lawyers strong in terms of our tech focus. We do a lot of work in the fintech space, but also across the tech sector generally. And that's all the way from advising startup strategy and startup structures through early fundraising rounds, A's and B's, through growth equity rounds, from involving the US growth equity funds, through pre-IPO rounds, and then listings and also exits as well. Our practice here is really designed to draw on the global expertise of DLA Piper and really bring best practice and market trends that we're seeing globally in the tech space to bear in the Australian market and for our clients. And that's really, I think, really a critical thing that sets DLA apart from other advisors in the Australian market, because what we've really got an eye on at DLA Piper is global expansion and our clients being able to expand globally and take money from offshore sources and make that easy for them by making sure that they're set up properly, and everything that they're doing in the interim leading up to either taking US money or expanding globally is done in a best practice way to make that as smooth as possible. In terms of what we do in the past sort of 3 years or so, we've probably averaged about 70 or 80 tech transactions a year And as I say, from Series A to Series B to growth equity from US funds, tech listings on ASX. We're involved with Life 360, incredible. We've also acted for Webjet since a very early stage in its life, but also buy side and sell side tech M&A, both for tech incumbents, but also non-tech incumbents who are implementing their transformation strategies that involve tech as well. And another important cog to our practice where we draw on, and I'm just giving you this intro because this is the stuff that I'm going to sort of tell you about what's happening in the market is drawn from our experience across all these sectors, is we've probably got one of the best practices in Australia in corporate venture capital as well. We act for two of the major four banks. We act for a very large insurer. We act for one of Australia's largest property groups. We set up Qantas's corporate venture capital fund as well. So we're kind of very close to what the corporates and the big corporates and the big incumbents are thinking about in terms of their tech strategy as well. So without further ado, the objective of this session here is really to share with you our learnings coming out of what we've seen since COVID-19 hit back in late Feb, and when the market really started to kind of squeeze and shut down and change really quickly. We're going to share some views about what we're seeing in terms of who's investing and who's not investing at the moment, or who's basically put their investments on hold. If time permits, I'll also kind of touch on kind of distressed fundraising situations that we've seen and that we've been involved with, and try and provide some tips coming out of that in terms of how people could be thinking about raising and what they can be doing and what their boards can be doing to support them as part of that process to best position themselves. Now, just a caveat, I just want to say the information I'm going to give you here is based on our experience as a firm. It's kind of real on-ground experience. It's based on the transactions that we're doing and our clients and the participants in the market that we're dealing with. I have no doubt that many of you have been listening to other webinars put on by VCs and other organisations out in the market. So there may be a bit of overlap. There might be some different things that you're hearing there, but I think what I really hope is that there's, at least for those people, there's something new that you're hearing here that you didn't know, and for others, hopefully there'll be quite a bit to kind of think about as you go on your fundraising journey. So that's kind of where we are in terms of kind of market trends and getting into the kind of detail now. So I think the stats show that Rita put up earlier that that not just Insurtech, but there was strong capital raising and investment momentum in the tech space in calendar year 2019, and also in the first 2 months of 2020 as well. There was plenty of opportunity, or there's plenty of activity both globally and in the Asia Pac region, and we had plenty of deals on in over that time. And over Christmas, a lot of our tech team didn't actually get to take their holidays because we had so many US growth equity fund deals on the table that had to be closed by the 31st of December, or for whatever reason. And for those of you who deal with the US, that they don't take breaks over Christmas and New Year like we do here. So there was a lot of activity there. So the onset of COVID hit sort of, I think, late kind of February is when we really started seeing it. And then investment activity really started slowing in March. Effectively, by the third week of March, anything that wasn't kind of signed already and just needed a closing exercise to close it out was pretty much put on hold and put back up on the shelf. And that really was driven by either companies really thinking about, well, we need to look after our own turf, our own home. And so any investment M&A or even corporate venture capital at the mothership was put on hold while people were seeing what was going on. And then for the VC funds, and other kind of investors, they were really thinking about, well, hang on, how long is this going to go for? Do we really need to start thinking about how we're going to support our portfolio companies or our investments there? And so just kind of put deals on hold and up on the shelf. And our group, we probably had about 10 deals fall over or be postponed at that point in time. People are asking us, do we think that those deals will come back? I think the short answer to that is no, we don't think they will come back. The landscape has changed, I think, too much at this stage. And even if they were to come back, we think that the reality is that there'll be a completely new deal. It won't be the same deal that we were talking about pre-COVID. The parameters have changed around cash and use of scrip in deals and valuation mechanics as well. So what we've been saying to our clients is, if you had a deal pre-COVID, you may as well just rip that up and put that in the bin, even if you're talking to the same suitors, because effectively, you may as well start again from scratch, and the conversation will start from scratch. And you can't really be aggrieved about that. It's just a function of the market and where it is. So it's the reality of kind of the situation that we're in. So we also had, obviously, in addition to kind of tech investment deals and tech M&A deals, the IPO window effectively closed for tech. We had a couple of IPO mandates on at the time that just shut down. Volatility in the market, plus also the downturn in the market, and then also the impact on revenues that the COVID crisis had on a number of tech companies, but who were already listed on the market, spooked the underwriters, spooked the investment banks, and also spooked the companies as well. So, we think the IPO window is now effectively closed on ASX this year. And I'll mention a bit later, I think, where that might reopen and how that might reopen. In terms of kind of pre-IPO raisings, that pre-IPO sector, where it's a kind of 2-year, 12-month lead in to an IPO, we didn't actually have anything in the shop at the time. The pre-IPO kind of window is April to kind of June each year, after the announcement of the first half year results come out. And so it can't really pass a comment on what was happening in that pre-IPO market. There was just about to kind of reopen, so we didn't have anything in the shop at the time that when COVID kind of hit there. A key exception to kind of stalled deals was the growth equity deals coming out of the US. So growth equity being the 20 million to 50 million kind of check size, US dollar check size, that those growth equity funds out of the US are typically playing in that part of the market. So those deals that were kind of on foot or very, very much towards the end of the negotiation execution phase after a long courtship continued, and a couple of those deals closed. And so, like there's that. The caveat I want to sort of add there is, those deals were done on the basis of a kind of a long courtship. Obviously, there would have been in the US growth fund a conversation around, or a discussion around, how do we think this is going to impact the business going forward. But we on the whole, the transactions that we were working on in that space at that very, very pregnant stage went ahead. And also pass a comment later about, those US growth equity funds are still quite active in the market, and been telling us that they want to be active in this market, even though there's still the uncertainty. So then what happened there? In terms of what happened then, we had a number of startup clients who had deals postponed or stalled, who needed to raise capital. And I think what we saw in those kind of first 3 weeks of March is, after they stalled, they very quickly just went back to their existing shareholder base, and we saw a number of small convertible note deals taken from their existing shareholders. Short-term notes, 12-month maturity in most contexts, and also they were carrying a kind of discount on conversion to a range between 15 to 20% on the next qualifying round price as well. And really, those rounds were done to just extend the runway to the next qualifying round. Valuation is obviously an issue in any fundraising process, even harder at this stage in this part of the market now, what we're seeing now. So, convertible notes were a viable option for people to sort of not have to negotiate on a valuation at this stage and really postpone that that valuation kind of discussion till the next qualifying round, which is hopefully within a 12-month time once the markets reopen. Other clients kind of completely shelved their fundraising process, or looked or kind of gave us an indication that they just kind of sit for a month or two and see what happens, and see where the dust settles, and to see if some certainty will return to the market. Understandable, again, that they don't necessarily want to have the valuation discussion at this stage, but there is we see some risk in that. Traditionally, the private markets will follow the public markets, will lag the public markets by months, sometimes up to 6 months in terms of what's going on. I don't think I think what we're going to enter into now is a period of a real credit squeeze, a real sort of cash squeeze in there, particularly probably in 12 months' time, 12 to 18 months' time. I think we're going to see the worst of the market. So I think, just a word of caution to those out there who are thinking about a raise in the next 12 to 18 months. We don't think that delaying a raise too much beyond the next 3 or 4 months into next year because you think it's going to bounce back, it may not be a necessarily great idea, because we just think that the access to capital may actually get harder within that time frame. Not saying that we're the holders of all knowledge on that, but I just think it's what we've seen in previous downturns is the squeeze in the private markets really comes, even after the public markets have returned or had a hockey stick kind of bounce back from their lows. Corporate venture capital was actually holding up not too badly in the first part of the COVID lockdown. Again, there's a lot of sort of deals. We're not talking about huge check sizes here, and a lot of deals kind of continued to be implemented. Again, that they were following on from a pretty long courtship pre-COVID, so that made those ones easier to get across the line. I think what we're seeing now is, the CVCs are really taking quite a defensive strategy, and this is pretty much across the board. A lot of the CVCs involved in fintech were already taking a bit of a defensive strategy post the Royal Commission. So this is a bit of a double blow here in terms of now really kind of keeping their powder dry. And what they've been telling us is we're really looking at keeping our whether they've got a CVC fund or just a CVC arm that's got an allocation of equity, is keeping that dry to support their portfolio companies and really do follow-ons through this period to support their portfolio companies through that. They will still do new investments, but it really needs to be a compelling investment for them that really aligns with their core strategy for them to be really looking at it. So we've been doing a lot of work in a lot of the sectors that have been really hit hard by COVID-19. No surprises here. The travel sector and anything that's supplying it. IT services, consultancy and managed services offerings have been hit really hard. Our clients in the payments space, have been squeezed by increased chargebacks and, a large risk in counterparty solvency have been hit really hard as well. Real estate tech and auto tech has been really, really hard. And, I think that there's no magic in that. I think it's pretty obvious from the lockdown and the outcomes of the lockdown that those sectors have been hit pretty hard. Where we've seen sectors going really well across the tech sector is kind of online medical devices, particularly in the diagnostics space, AI debt collection, reverse mortgages, and government and education services. Again, I don't think there's any kind of magic dust in. You've probably seen or read or heard all that before, but just wanted to give you a snapshot of what we're seeing across the tech market more broadly. So capital raising and who's playing in the market at the moment. So who's still investing or who's looking at investing in Australia? So what we've seen and gathered and been speaking to is the likes of Accel, KKR, Bain Capital, Five Elms Capital out of the US, KKR by itself, Level Equity, Up Data Partners, are all telling us that they're going to remain active in this market, and that there's no slowdown for them. Time will tell whether that is correct or whether they're just kind of a bit of bravado, a bit of chest beating at the moment. But certainly, they're pretty professional investors. They're large scale investors. So, they are certainly, I've got a client who has taken some money from one of those guys who's been told, go out there and spend that money, look for targets, look for where we can invest, and we'll back you in this space. So, there's a clear message there that those guys are looking at the market for really strong companies. They've got really strong fundamentals. Sure, there may be a chip on the valuation at the moment. They probably see a bargain at the end of the day. They're not pro bono private equity firms. The venture capital firms are there to make money. So if they can sniff a bargain, they'll have a crack at an opportunity to see if they can get it. On the funds that play in the pre-IPO space, kind of mentioned before that window was closed, but we actually thought that window would stay closed this year. Just on the basis of the really strong reaction, the market reaction to the COVID-19. In fact, that's not actually been the case. Our team, our guys in Melbourne, have been engaged earlier this week by one of the funds that play in the space on a pre-IPO deal, where we see so that's promising. So I think that's really promising. I think, and I don't know the details of who the target is in that space, but I think where we'll see the pre-IPO funds playing in this market is those tech companies who are looking at potentially listing this year, who have taken themselves off that ASX listing runway just because of the market or the shutting of the IPO window, who actually do need a bit of capital just to get them through the next 12 months or even through that listing period when it reopens next year. Have taken, the other people who are speaking to those pre-IPO funders. So I don't think they're going to be huge rounds. I just think there's going to be enough in those rounds to give them that runway to hopefully be looking at an IPO this time next year. So I think it's the guys who are already preparing to do an IPO who will be active in that markers, and I think certainly the pre-IPO funds, will love those opportunities because for them, they get a pretty good deal in terms of a fixed IRR return, plus also pretty much a fixed end date in terms of an actual listing requirement within 12 to 24 months of doing the deal. There's always some benefit for them. They don't want to necessarily see this, but if an IPO doesn't occur, then obviously they get a better deal on the backside of that as well. So I think there's plenty of funds out there for that stage of the market. Who's not investing? So look, I think at this stage, and this is sort of only based on the last kind of 2 months of what we're seeing is, we're not seeing a lot of activity for high net worths at the moment. We're not really seeing them come into the market and play. A kind of substantial exception to that was a very famous mining magnate from Western Australia and also an ex-Prime Minister who have been fairly bullish in this market and have been writing a number of checks around town. But we don't act for those guys, but they've been taking some pretty strong positions around town. The high net worths that we kind of deal with and seen investments have certainly taken a backseat and are certainly less active. The main reason for that is just the uncertainty. The valuations are all over the shop at the moment. They've also probably taken a hit in their various sort of private offices as well. So they're just keeping their powder dry just to see what's going to come out. No one wants to be the first person to do a deal and have it fall flat on its bum and be embarrassed about it. So they're just playing a waiting game at this stage. The other people who aren't investing at this stage, or we think won't be investing in the short term, are the VC funds or the PE funds that raised their funds more than 3 years ago now. So where the majority of the fund has been deployed, effectively they're just concentrating on follow-on investments for their portfolio companies as well. They won't be looking at any large investments into new prospects at this stage. And in fact, what they're going to be doing is looking at their whole portfolio and trying to reframe how they're actually going to position themselves, their portfolio, for exits that otherwise may have occurred in the next 12 to 24 months, and thinking about how they might have to prolong that runway, and what they can do in the interim to boost value, or actually kind of get a partial exit from that as well. US VC and US growth equity funds. So our guys in the US and our clients in this space are telling us that the US VC funds are still active in that market, and they're still, and they're looking for growth. The growth equity guys are looking for growth equity investments as well. The VCs are still taking decks, and obviously, and they're still doing pitches via VC, so they're still quite active in the market. I think the hardest thing in this market with kind of US VCs, probably easier with Australian VC or just Australian investments, is there's a real kind of touch and feel about meeting a founder face to face, or an investment team face to face, and getting that. The whole pitch exercise, I think, complicates that, because the real face-to-face contact and meeting and building that relationship and really understanding whether an investor is right for you, or a portfolio company or founders are right for a VC, is really important. That's going to be a real hurdle for people to overcome in doing investments. The growth equity space. Look, we're seeing a couple of term sheets in that space already. As I said before, they still want to be active in the market, so we're seeing some investment activity there as well. One of the key things that you need to be understanding if you're looking at growth equity or a US investor is the changes to FIRB that came in with the COVID crisis. So for those of you who don't know, the foreign investment or the treasurer basically now mandated that if anyone coming in is a foreign investor is taking more than 20% stake in an Australian company, they'll need FIRB approval for that. And they've also pushed out the time or the expectations for that foreign investment approval could be anywhere up to 6 months for a deal. Now we don't usually even see, unless it's a big round, we don't even usually see FIRB even being a feature of tech investments in the Australian market. But you're going to need to factor in the fact that you might be looking, depending on how much overseas money, foreign money you're taking, factoring in a 6 month pre-completion window to get a foreign investment approval as well. Now, it might not be 6 months, and we've been working with FIRB with a few ideas to try and get around that with some success, but they've just got because they've effectively lowered the threshold for notification of transactions to $0 as opposed to $270 million or even higher from free trade agreement countries. It effectively means that every deal that has a foreign buyer is going to FIRB, so their workload is just off the scale. And so getting anything out of them quickly is going to be a real challenge. So what we're seeing in terms of people talking about that, and even our clients outside of the tech sector talking about that, is where foreign money is coming in and where a foreign buyer or foreign investor may be leading around, they're really searching hard to find local Australian people to partner with to bring their stake maybe down to 20%, but also potentially looking at increasing their economic exposure through synthetic kind of swap instruments and things like that, which don't necessarily trigger FIRB approval issues. But there's, it's kind of a technical, hard kind of work to get around it, but there are ways around it. But it's an added complexity that we didn't kind of need in this space, and we know that so many of our tech clients will need capital during this period. I'm probably running out of time, but
thanks, Lyndon. We might have to pause there. So much content to go
sorry
through.
I just kind of got so much to talk about.
No, absolutely, and we might have to have a part 2, absolutely, like we were saying before. But you've already actually got some questions in the Q&A, but please remember to pop your questions in the Q&A if you have specific questions you'd like to raise. soon. So I am now going to hand over to Simon Odell, who many of you are familiar with. Simon is the CEO of Insurtech Gateway Australia, and I'll let him do a little bit of an intro into Gateway and what they're up to, and specifically some Insurtech trends that he's seen here. Thanks, Simon.
No worries. Thanks, Rita, and thanks, Lyndon, for that. I think that's a really good preface and foundation from which for me to lead from. And as Rita said, dive a little bit deeper into the Insurtech space. And yeah, super keen to get to Q&A in about 12, 15 minutes so Lyndon and I can respond to your questions. So keep them coming in. I'm going to share my screen with you because I've got a couple of slides. Just bear with me a moment. Is that coming through okay?
Yep, thanks, Simon.
Okay, cool. That's better. Okay, great. So my goal in this presentation, as I said, is to dive a little bit deeper into Insurtech as a vertical based on Lyndon's foundation. So thanks for that. In building up a platform, a credibility platform from which we can share our observations. I guess the Insurtech Gateway in London was the most prolific investor in the UK in 2019 in terms of deal count. And I think it was second in Europe. And we're looking to emulate that here in Australia. In Australia so far, we've made 2 investments so far this year, or backed 2 companies, which we're really excited about. So just a little bit of a preface on Insurtech Gateway. To keep things simple, we refer to the Gateway as an incubator plus an investment fund. So in reality, given the barriers to entry, providing a service is much more about capital. It's entails a lot more services as well. So as you can tell from this quite quirky illustration, for founders, it's all about speed to market and minimizing dilution through investment rounds. So we've built our proposition around that, which is basically across 3 pillars, which is mainly around venture building and also insurance, which is about fast tracking access to insurance capacity, the right capacity, and also providing regulatory permissions for founders as well. And then obviously capital on top of that. So in terms of our portfolio, we have 14, maybe 15 as of this week between London and Australia. And as I mentioned, we've just backed our first 2 Insurtechs here in the Australian market, which we're super excited about. They'll come out of stealth mode in the next, we'll hopefully be able to make that announcement next month in June. So the majority of Insurtechs that enter our program are at the pre-seed stage, which is essentially a founder with a strong CV and a compelling idea, basically, and we surround them with the services that were mentioned in the previous slide to be able to help them get a pilot in the market. Some founders come to us with an MVP, but all generally come to us pre-product market fit, and our specialty is to help de-risk those investments through those high-risk early stages of commercializing their ideas. So likely the best example I can give in terms of the portfolio and their journey is one who came to us, or Gateway London, at an idea stage, and they launched a pilot in mid-2018, 2 years ago, and they're just closing around now, or just closed around, valuing them at just over 120 million Australian. So from pilot launch to a valuation like that within 2 years suggests that the model seems to be working, and we're quite proud of it. And it's not necessarily an outlier, that example I give. So we're quite proud to be, I believe, the only independent authorised Insurtech incubator in the Australian market. So with that preface, a bit of background on Gateway, I'll jump into the numbers, and thanks Adam Baker, Andrew Johnston and the Willis team for They're reliable quarterly Insurtech briefings. It's nice to get some quantum to back up our subjective observations into the market and so on. So to frame up this discussion, I thought I'd draw out a few points. In terms of deal count, P&C as opposed to life in early stage investing, which is pre-seed, seed and Series A, represents 71% of the market versus the residual being life. And in terms of deal volume, so the capital volume, that gap is even larger. So for those seeking to see innovation in the life space, it's a little bit disappointing, and we'd certainly love to see some more deal flow coming in the life space. And I know that there's a lot of primary insurers and reinsurers out there that would love to see that as well. We're seeing the corporate VC strategic investors like your Axel Innovate and Allianz X definitely shift up towards the later stage investments, and that was represented Q4. And when I say these quarterly, I'm talking about calendar year to align to the US, because that's where we get a lot of our data from. Q4 and Q1 this year as well. So it's the more institutional VCs that are focusing on early stage. I think they're more equipped to provide that level of strategic support for the early stage investors. The CVCs are obviously well equipped to provide access to customers and other services as well. So I guess it's a bit of a few pros and cons there. So we've seen 223 million in capital invested in early stage deals Q1 2020, which is slightly ahead of Q1 2019, which sounds a little bit counterintuitive based on what we've heard so far in this presentation. But I guess this is early stage deal volume, so it's the later stage deal volume where we saw it mainly fall off a cliff. And I think early stage and late stage we'll see the numbers significantly decrease. Pretty obvious statement for the Q2 2020. So it'll be really interesting to see what happens there. All right, so moving on. Just bear with me a moment. So I guess we're coming into an interesting time for founders. As Lyndon mentioned, many are looking to, as per that survey, 35% are looking to raise in the next 3 to 6 months. And many are looking to extend their runways out, because generally the further it's perceived that the further you get out from the bottom of a downturn, the better the prospects may be to be able to close or subscribe around. So I guess it'll be interesting to discuss that in the Q&A if we get an opportunity. One of the negatives of extending the runway and popping out in Q1 2021 with a pitch deck and seeking to raise money will be, I think a lot of Insurtechs will be doing that. There'll be a lot of pitch decks and founders hitting the market. So what will that supply do to valuations? That will be quite interesting to see. So as Rita mentioned in the opening, there's 2 business models that represent 90% or the vast majority of deals, and the largest being B2B SaaS, and followed by MGA business models. They make up the 90% of the deal volume. So I thought I'd call out some of the trends in the subsequent slides that we're seeing in those 2 areas in terms of where the money's going, where the early stage money is going. So in terms of SaaS, B2B SaaS, claims management is a really strong focus at the moment that we're finding. And one of the more interesting spaces there is the number of Insurtechs that have popped up offering automated vehicle damage detection, which I think is quite interesting. So Tractable and Click-ins are 2 who have attracted some fairly decent, in the context of early stage rounds, fairly decent volumes of capital of late. And there's many others out there as well, but these are probably 2 of the best examples. So their solutions are generally based on AI and machine learning. Click-ins seem to take it a little bit further in terms of their tech, and they converge 8 different technologies to create their solution, including AI, mathematical modeling and multiple engineering disciplines as well. So it's as deep tech gets, I guess you might say. So essentially these solutions allow a customer to take a photograph of their motor vehicle following an accident, and based on that simple photograph or two, it's processed through the tech, and it can flag fraud and identify the extent of damage for a claim to be processed in a similar function to what a TPA would provide. So it's quite interesting in the downturn. Also, in the context of the downturn, given that insurers will be looking, or traditionally in downturns, insurers look internally for cost efficiencies and so on. So I think that this will be a continued area of focus as we come out of the bottom of the downturn, these automated vehicle damage detection services. On the MGA side, one of the more interesting areas that we're seeing, which is the second largest business model, being MGA, is usage-based insurance. And there's a couple that have popped up in Australia recently as well, which is quite exciting to see. But we're seeing a lot of capital being invested in private motor usage-based insurance. You might characterize this market as exploding, given that it's grown at 85% year on year, and expected to reach about 115 billion, and that we think that's quite conservative over the next 6 years. So the shift to usage-based insurance is happening in recognition that the mobility market, as you may have been reading and picking up on, is the mobility market incorporating vehicle commuting is moving to merely transport rather than ownership. So more leasing, more hiring of services for a single trip, and less ownership. So insurers with a blunt annual policy, you might say, will need to adapt their rating models and their policy structures if they're wanting to capture that market. So I think it's forecast that, motor insurance is the largest single GI line, and I think it's forecast that 1 in 4 or 1 in 5 premium dollars will be through this market before 2027. So it's it'll end up being quite a big market. So at Gateway, we're particularly excited about this space. So other areas where we're seeing trends and where the money's going is new economies. So gig economy, collective, and upcover, looking to do good things in the Australian market, and sharing economy, new risks like digital assets, crypto insurance, and so on, and social impact. So I wanted to dive just a little bit further into social impact before we jump through to Q&A. Oops, I've gone somewhere else here. Just bear with me a moment. Here we go. So it's not reflected in the numbers yet, though. We're seeing a lot of deal flow come through and observing an emergence in the social impact space. So we have unique and important problems to solve here in Australia. The increased frequency and severity of nat cats from global warming and last summer's bushfires, for example. And it was interesting speaking to our global counterparts in the UK, Tel Aviv, New York, and so on, that the bushfires were obviously the #1 topic globally for many weeks, if not months. But more so that the startup community really felt a lot of empathy and wanted to solve for some of the problems, including those bushfires and our resilience or lack thereof through that catastrophe. So there were hackathons held in Tel Aviv, New York, and all around the world to help create some solutions to align to the needs of the Australia-specific pain points. So it's quite exciting to see some of these social impact founders coming out of the woodwork, and we see some really promising ideas coming out of it, and some of the ones we're looking at the moment as well. So I'll give you a couple of examples. One is smarter and reliable risk modeling that can help with anything from propagation mapping for floods and bushfires, which will consequently save homes and lives and so on, because it can help people know whether to evacuate their homes and so on right in the heat of a natural catastrophe. So we're pretty excited by that. Other things that this innovation through necessity is creating is a fast tracking the presence of parametric insurance in the market. So they're able to create more objective triggers to create a parametric insurance product covering lots of different events like flood, bushfire, even hail and storm and earthquake and things as well. So if you look at this chart that's on the screen, we know there's a gap, and there's always been a pretty significant gap between insured loss and total loss. And surely that represents the scope of opportunity for our industry to augment. And from what we've seen, Insurtech will be key, in some of these technologies that I've just mentioned will be key in the industry capturing this additional premium opportunity. For example, there's one state government who I won't mention who have $60 billion in assets that they can't insure because they can't get a profile of that risk because the risk modeling is unreliable. So to be able to understand that those risk profiles and have the reinsurance industry insure those risks will help close that gap and help augment the industry. So we're quite excited by that. So yeah, I'll finish there and jump into some Q&A, Rita.
Great, thank you, Simon. That's awesome. So just a reminder, if you do have any questions, just pop them in the Q&A button, via the Q&A button. So I'm going to dive straight into it. Probably we've got about 5 minutes for Q&A. And if there are any leftover questions, we can come back individually to those that ask them. So the first question for Lyndon, are there any lead indicators you see or look for when markets are starting to open up again, other than checks being written? I think you're on mute, Lyndon. Sorry.
So sorry about that. I think that, I mean, the check's being written is the key indicator. I mean, people will start to come back in the market. People will start, people are continuing to take decks and listen to pitches. I really think that what's going to start is when checks start getting written again is going to be the lead indicator of where the market's starting to turn. And people will sit back and wait for checks to be written, and then you'll start to see the volume in terms of deals starting to pick up. And that's when, who knows when that's going to happen. It's really going to be about when confidence returns to the market.
Great. Simon, just a question around whether Insurtech Gateway is also investing in other regions other than the UK and Australia, such as Asia. Sorry, you're on mute, Simon.
Okay, thanks. The Gateway certainly is investing in other regions. We like to help Insurtechs who are at an early stage scale into the UK market or the Australian market, or to help realise some market fit in their existing market. So our strengths are such that we will focus on deal flow in our home markets, the UK and Australia. However, we do have a couple of exceptions, like an earthquake parametric that's in the US that we're hoping to scale out there. And we are very interested. We have 2 scouts in Southeast Asia. We are quite interested in that market as well.
Great, thanks, Simon. Just a question probably for Lyndon here. Who are the US growth equity investors that are still active, if you're able to divulge that?
Yeah, no, so that was I should have mentioned that when I was talking about who's still investing. So that's your Accel, KKRs, your Bain, your Five Elms Capital and KKR, those players. In Australia, Macquarie, we understand Macquarie is still active in that space as well. So it's not just all US growth, but a couple of players in the Australian market as well.
Mm-hmm. Great, thanks. Question for Simon. Are you open for Insurtech in the travel insurance space, or I guess interested in investing in that space?
That's a good question. That's a pretty hard one to answer at the moment, given the potential restrictions on travel in perpetuity. I think always looking for clever ideas, new ideas, and won't write anything off, even in a market that's pretty stagnant in the current time. So I think, for example, with the current situation with travel, I guess there's a few problems associated with travel. So there might be solutions come into the minds of founders that are looking to introduce into the market that will help solve some of those new problems.
Great. A question probably for both of you, Simon and Lyndon. Is there any evidence that the investment will move further up the chain to later stage investments, i.e. moving from pre-seed C to Series B and C?
Yeah, look, my view, it's probably a bit too early to tell on that. I think my view our view at the moment that we've talked about internally is because from an Australian VC perspective, because they're keeping some of their powder dry, we think that there'll be a shift actually to more seed Series A deals than Series B and later stage deals. Because of that, because they need to take the portfolio approach. So they still need to be doing a number of deals. And so we actually think there'll be, as a consequence, more deals in that earlier stage space, such that we think the volume in that space may even actually be the same as what it's been previously, or overall the value that they'll be investing might be smaller.
Yeah, the only thing I'd add there is I think there will be a lot of deals out there in terms of valuation. So I think there's been valuations have come back to earth. We were very much due for a downturn based on the factor of the hyper inflated valuations out of the US mostly, but other markets as well, for early stage startups who hadn't really realized many metrics or milestones, and yet they were being valued at what some call silly levels. So I think the valuations will be coming back down. So there'll be some extra incentive for investors to ignore some of the macro conditions and try and dip their toe in. And I think from what I'm seeing, it's the more experienced institutional VCs who are leading the way now, as in April and May, in some of those rounds, which is generally a nice indicator as well.
Great. And I think we'll have to make this our final question. Simon, as an early stage investor, what size checks are your mandate?
That's a good question. So we write checks anywhere from 50K to 150K as Insurtechs enter our incubator. We have a group of angels and we have a fund, a £30 million fund. It's a micro fund. It's £30 million. So what's that? 60K Australian. So when the Insurtechs come out of our program and hit certain metrics with their pilot, they're able to pitch to our fund to get more serious rounds of capital, and we bring in other investors, institutional investors who sit within our group, who also contribute to a healthy cap table as well.
Great. Thanks, Simon. And I know we have a few more questions and we'll respond to those individually offline. But I'd just like to take this moment to thank both Lyndon and Simon for your time. It's really been fantastic having you on here today, and thanks to everyone for joining us as well. I just wanted to give you all a very quick reminder of some of the events that we have coming up, and there may be a slide that flicks up on the screen. Which is, we have an event next Wednesday around digital transformation, and an event on the same day around the claims value chain with Insurtech NZ. And then 2 weeks after that, we have our very first global Insurtech event focused on the Asia Pacific region with a number of our Asian counterparts. And then on the 3rd of June, as I mentioned at the start of the session, we have a session with Better Labs Ventures, which should be a really good one. We may also look to follow up. Obviously, this has been quite an insightful session, and based on, I guess, input and feedback from yourselves, which we'd love to hear. We may do a second session a little bit down the track around investment because it is a really important one for our ecosystem right now. So if you do want to connect specifically to any of the speakers, obviously reach out to us or give us some feedback. We'd love to hear from you. And on that note, I just want to say thank you all for joining us, and we hope to see you at a future session. Thanks.
Thank you.
Thanks, Rita. Thanks, Lyndon.